Savings basics and the emergency fund. How do you manage to save money? And what is an emergency fund? The emergency fund is the first step in savings and is very important in your overall financial wellness plan. It is very important to have an established emergency fund. And it is very important to have an established, effective budget that allows for your monthly cash flow to fund the short-term and long-term savings goals. Having the ability to manage life's unexpected financial expenses is a crucial part of your overall financial well-being and financial wellness plan. It is also important to know that your long-term financial goals are on track and that you will have a comfortable standard of living in retirement. In this module, we're going to basically go over how to save money. Savings basics, how to save for a rainy day. In this module, we're going to go over how to establish a budget, how to get out of debt, how to save money, and how to plan long-term, and best practices on how to save money. Budget, have an established budget. Cash flow, make certain that you have the cash flow to finance your savings goals. Expenses, you must manage your monthly expenses. List and track your monthly expenses and know where you're at and how much you can save each month. Debts, manage your debts and your debt-to-income ratio. The debt-to-income ratio is the debts listed on your credit report relative to your income. Calculate debts that are not on your credit report. Keep your revolving debts at a limit of 30% or less of their available credit. The Budgeting Basics Financial Wellness module outlines the 50-30-20 budget rule. If you haven't watched that, please go back and review that. The budget is the foundation for creating your overall financial wellness plan. Short-term savings goals, long-term savings goals, and specific savings goals are also key and crucial to an overall financial wellness plan and your financial well-being. How to get out of debt. It's recommended to consolidate your debts if possible. Consolidate your debts to a low-interest home loan or personal loan. When you start paying your debts, I recommend what's called the snowball method. This starts with listing all of your debts and their minimum payments. You're going to focus on paying the smallest debt first. You do this by paying the minimum amounts to all debts except your smallest debt. Pay the maximum each month available from your 20% savings fund to the smallest debt until it's paid in full. Then you're going to pay your next smallest debt and continue the process. It's important to try not to add additional debts, revolving debts, or term debts while you're trying to pay off your current debts. Managing debt is a major component of creating an overall financial wellness plan. How to save money. It all starts with the budget and analyzing the monthly cash flow available and how much you can save. You're going to set realistic savings goals. We're going to establish emergency fund goals, short-term saving goals, and retirement goals. Maximize your company's 401k to get the maximum offered matching funds. Experts recommend saving 10 to 15% of your gross monthly income or gross annual income for retirement. Set a retirement goal as soon as possible. Having an ultimate retirement goal is a major part of an overall financial wellness plan and gives you a lot of peace of mind. Experts recommend a target savings amount of 25 times your expected annual expenses in retirement. So if you think it's going to cost you $25,000 a year to live in retirement, a goal would be $500,000. If you need help with this, I can give you general advice, or I recommend you talk to a financial advisor. The emergency fund or the rainy day fund. The emergency fund is recommended to be 2 to 3 times the amount of your monthly expenses. The maximum recommended amount for this fund should be $15,000 to $30,000. Experts also recommend keeping 3% of your net worth liquid. Liquid means available right away in case of an emergency. Your net worth are your total assets minus your total liabilities. Your liquid assets are finances that are easily available and accessible if needed. Designate a separate account at your bank or credit union for your emergency fund. If you can have a direct deposit sent each pay period to your emergency fund, that would be recommended. The emergency fund may be utilized to pay for unplanned expenses or to reduce revolving debt limits. If your credit cards get high, feel free to use your emergency fund to pay those high interest loans, and then try to repay your emergency fund like you were loaning yourself money. The emergency fund is the first piece of the savings puzzle in creating overall financial wellness. It is really important to have the ability to pay for unexpected emergencies. Short-term savings goals. Short-term savings goals are saving for a specific item like a new computer or a new car, saving for a specific event like a vacation or a holiday gift or a wedding. If your revolving debts get out of hand or get high, your balances get high, these accounts can be used to pay those debts, and then I recommend trying to replenish that account. It's almost like you're the bank, you're being your own bank, you're lending yourself money from your short-term savings goal account. Designate a separate account for each savings goal. Set a realistic time frame and monetary amount for each savings goal. This is based upon your cash flow from your budget. If possible, have direct deposits from each pay period deposited to each specific savings account. That way you don't have to do it and you know that the money is getting into the account and that you're on track. There are websites where you can view all of your accounts and track your net worth. Also, celebrate when you reach a savings goal. If you do reach your new car goal or holiday vacation savings goal, maybe treat yourself to dinner, celebrate, because it is a big accomplishment hitting your savings goals. Long-term savings goals. Long-term savings goals include investing for retirement. Experts recommend saving 10 to 15% of your gross income for retirement, and this can be your company 401k and the match. Saving for a new home, wedding, and college are also long-term goals. These goals are longer time frame goals. These accounts may be invested in accounts that achieve a higher rate of return, and they're not going to be needed for a long time, so you can actually put them in an investment account. Financial advisors can help invest these funds for a maximum rate of return and also to achieve the most favorable tax advantages. A strategic long-term plan is the main component for creating overall financial wellness. Best practices to save money. Make certain that you have an established and effective budget. You must know your cash flow and how much you can save each month. Establish monetary goals for your future short-term requirements. Dedicate individual savings accounts for each goal. Have your payroll provider send small amounts to each pay period to the dedicated accounts. This way you know that you're going to be on track. Plan your major purchases according to the annual sale periods. Try not to make any large purchases unplanned unless it's an emergency. Track your monthly spending and cash flow. There are many different electronic tools that can help you track your spending. Plan to save any unexpected additional income like a bonus or a tax refund. This has been, personally for me, the way I have managed to save money throughout my lifetime. Anytime I get a bonus or any expected money, I put it directly into an investment account, and it does add up over time. Review your loan rates and terms to make certain you aren't paying a higher interest rate than possible. Interest rates fluctuate, and it's important to review them annually to make sure that you're paying the lowest rate possible. If you're having any issues establishing savings goals or reaching your savings goals, I'm available for personal consultation and guidance. I would love to help you. Thank you.